Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have David Grumhaus, President and Chief Investment Officer of Duff and Phelps Investment Management, to discuss investment opportunities in listed real estate assets and how they are impacted by inflation and the Russian invasion of Ukraine. David, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. It's great to be here.
You got it. And within listed real estate assets, how have real estate securities and global listed infrastructure traded in 2022?
Like the rest of the market, it's been a little bit of a bumpy year. U.S. REITs are down about 10% this year, so pretty much in line with the market. Now that's coming off a very big last year where they were up over 43%. So we're seeing some mean reversion there. I think some of the growthier aspects of the REIT sector, such as industrials and data centers, have struggled as we've seen this shift from growth to value. Meanwhile, some of the value sectors like lodging and office have been some of the best performers of the year from the REIT sector. Similar story for global REITs. They're down about 9% year to date. They're coming off about a 27% up year last year. GLI, global listed infrastructure, has been better, down about 5% year to date. Energy infrastructure has certainly been a big helpful driver for global listed infrastructure this year. Also, the UTs have been more defensive and have traded better than the broader market.
And the inflation picture has changed dramatically since you and I spoke last. What does that mean for listed real estate and infrastructure?
Jill, it certainly has changed a lot. I mean, we were a pretty outspoken critic of the whole transitory inflation last year. We really did think that inflation was going to be more permanent. Obviously, the market has become grown much more in that camp. We're very hyper-focused at this point on inflation, given the surging CPI and PCE numbers, as well as obviously what's now going on in the Ukraine and the effect on that on energy prices and food prices. No question that inflation is helping both of these sectors. I think a lot of the movement in the REITs last year was driven just by people wanting to get this inflation protection. Real assets typically do well in an inflation environment. These are higher fixed cost businesses, much higher replacement value of assets, longer term contracts with inflation escalators. So it is a natural place for people to go. As you can see in the chart that I have here, over the past 50 years, REITs have done quite well and outperformed the market in periods of both moderate inflation and higher inflation. Many REIT sectors not only have annual contract step-ups, but they also have the ability to raise rents. So think of apartments or self-storage in those areas where you get pretty regular rental increases yearly at the worst, and sometimes even sooner than that.
Let's talk about geopolitics for a moment here. How is the Russian invasion of Ukraine impacting these sectors? Are they a good place to hide out?
It's a good question. I think on a basic level, our sectors are more defensive. They offer higher relative dividend yields. And so they generally do outperform the broader equity markets when we have situations like this. And historically, that's been the case in similar situations. Now, you have a lot of different subsectors within these various sectors, and certainly the performance can vary. So take global listed infrastructure, for instance. You have a heavy weighting of utilities in that sector. And we think utilities are a very attractive place to be. They do carry higher yields. They are much more stable businesses. Obviously, a good portion is U.S. based, so that's a little bit more U.S. centric. And look, utilities were also the worst performing sector last year. So we do think that they're a good place to be hiding out. As you can see on the chart, we also think utilities continue to look undervalued. On a relative basis, they're still trading at a discount to where they have over the last 10 years versus the S&P. And so we think, especially given mid to high single digit earnings growth that we should see in those companies over the next 3 to 5 years, it makes them an attractive place to be. On the other hand, if we look at global listed infrastructure, a sector like international airports, obviously struggling right now given what's going on in the Ukraine and given the feared impact about what it might do for travel and also certainly on fuel prices.
And then if we take a look at the REIT subsector, what's attractive?
We think the REITs are still a good place to be. Obviously, as I talked about, we've had a little bit of pullback, but we still think that there's a lot of good inflation protection there and a lot of attractive businesses as we do reopen. We still really like residential, in particularly manufactured homes. We think that's a great place to be. Within the U.S., there's still a housing shortage, and we just think that makes it a good. And we think you're seeing real price increases, and so the combination of those two things make for an attractive sector. Industrials as well. Industrial sector performed great last year, but the fundamentals behind that and the secular story behind the whole increase in digital marketing and in addition, I would say with the supply chains and the supply chains having to get fixed, we think that'll be very good for industrial companies as well.
All right, David, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.